$100. That's it. That's all it takes to completely change your financial future, and most people are spending it on things they won't even remember next month. A dinner out? A couple of takeout orders? Maybe a shirt they wear twice and forget about. Gone. Just like that. But what if that same $100 every single month was quietly working in the background, growing, stacking, compounding into something that would genuinely change the trajectory of your life? Not because of luck. Not because of some secret strategy only rich people know about, but because of a force so simple, so mathematically powerful, that once you truly understand it, you will never look at a $100 bill the same way again. And the most frustrating part? Most people know this force exists. They've heard about it, they've nodded along when someone explained it, but they've never actually felt it, never actually seen it work in their own life, because they always quit too early. They start with excitement, invest for a couple months, see barely any movement in their account, and convince themselves it's not working, so they stop. And that single decision, that moment of impatience, ends up costing them more money than they could ever imagine. Because what they didn't realize is that they stopped right before the magic was about to begin. Here's the truth about building wealth that nobody in school ever taught you. It has almost nothing to do with how much you earn. It has almost nothing to do with picking the right stocks, or timing the market, or having some brilliant financial mind. The people who end up genuinely wealthy, the ones who retire early, who have real options in life, who never seem stressed about money, almost all of them share one single habit. They invested consistently for a long time without stopping. That's it. No secret formula, no insider knowledge, just consistencies compounded over time. And the vehicle that makes all of that possible, the engine running quietly underneath all of it, is something called compounding. Now, before you roll your eyes, because you've heard that word 1,000 times, stay with me, because most people hear the word compounding and think they understand it, but there's a massive difference between understanding a concept and truly feeling what it does to your money over a decade. So let me show you in a way that actually sticks. Imagine you plant a seed. After the first year, that seed grows into a small tree that gives you one fruit. Inside that fruit is another seed. So you plant that one too. Now you have 2 trees. The next year, both trees give you fruit, both fruits give you seeds, and now you plant 4 trees. Then 8, then 16. In the early years, you're looking at your little garden thinking, this is barely anything. But give it enough time and suddenly you have a forest. That's exactly what happens with your money when you invest consistently and leave it alone. Every dollar you put in earns a return. Then that return earns its own return. Then that earns a return. And it keeps stacking on itself, layer after layer, getting faster and bigger with every single year that passes. The first few years feel painfully slow. But somewhere around the middle, the curve bends upward sharply, and growth that once took years starts happening in months. That's the moment people call luck from the outside. But from the inside, it's just the result of not quitting. So let's put real numbers behind this, so you can actually see what we're talking about. You invest $100 every single month. Nothing more, nothing less. You put it into a broad market index fund, and your money grows at an average annual return of 8%, which is a conservative estimate based on decades of actual stock market history. After the first year, you've got around $1,250. You put in $1, $200 yourself, and the market added about $50. Barely noticeable, almost insulting, honestly. After 3 years, you're sitting at around $4,100. You contributed $3,600, and growth added about $500. Getting slightly more interesting. After 5 years, your balance is around $7,400. You put in $6,000, and compounding handed you over $400 for free. Now, after 10 years, here's where it starts to shift significantly. Your account is sitting at approximately $18, $300. You only contributed $12,000 of your own money. That means over $6,300 came purely from your money, making more money. You didn't work for that $6,300. You didn't stress for it. You didn't spend a single extra hour grinding for it. Time and consistency created it for you. But keep going, and the numbers become almost hard to believe. After 20 years of that same $100 a month habit, your balance crosses $58,000. You put in $24,000 total. The market gave you an additional $34,000 on top of that. And if you stay consistent all the way to 30 years, you're looking at over $149,000. You contributed $36, zeros of your own money across 3 decades, and compounding added more than $113,000 on top of it. That's not a typo. That's not an exaggeration. That is just math, doing what math does when you give it enough time to work. Now let's talk about where you actually put that $100, because this is the part where most beginners freeze up and end up doing nothing. They hear invest your money and immediately spiral into analysis paralysis. Should I buy Tesla? Should I buy Bitcoin? Should I find some hot stock that's about to explode? And because they can't decide, they wait. They research for weeks. They watch videos, read forums, ask friends, and by the time they finally feel ready, months have gone by and they've missed all that early compounding time that was the most valuable time of all. So let me cut straight through all of that noise and give you the clearest, simplest answer. For most people, especially beginners, the single best place to invest that $100 every month is a broad market ETF, specifically one that tracks the S&P 500. An ETF, which stands for Exchange Traded Fund, is essentially a basket containing hundreds of different companies all in one investment. When you buy into an S&P 500 ETF, you're buying a small piece of the 500 largest, most established companies in the United States. We're talking about Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Johnson & Johnson, and hundreds more. Companies that have survived world wars, financial collapses, recessions, pandemics, crashes, and every economic disaster you can think of. Instead of betting your money on whether one single company succeeds or fails, you're spreading it across the entire American economy. If one company has a terrible year, the other 499 balance it out. And over the long run, the overall direction of that index has been consistently upward. Over the last several decades, the S&P 500 has delivered an average annual return of somewhere between 7 and 10%. Not every single year, some years were absolutely brutal, but over long stretches of time, it has been one of the most reliable wealth-building tools ever created. If you had invested $100 a month into an S&P 500 ETF over the last 30 years, you'd be sitting on somewhere around $180,000 today, despite only putting in $36, zero of your own money. That's the power of a simple, boring, consistent strategy applied over enough time. And speaking of crashes, let's talk about something that trips up nearly every beginner investor, because this mindset shift might be the most important thing you take away from this entire video. Most people are terrified of market crashes. They see the news screaming that the market dropped 20%. They watch their account balance shrink, and every instinct in their body tells them to pull their money out and wait until things feel safe again. And that instinct, that completely natural and understandable emotional response, is precisely what destroys long-term wealth. Here's what actually happens when the market drops and you're still investing $100 a month. Your $100 buys more shares than it did before the crash because the price is lower. Which means when the market recovers, and based on every historical example we have, it always has recovered, those extra shares you bought at the discount multiply your returns even further. You end up richer after a crash than you would have been without it, but only if you stayed invested, kept contributing, and didn't panic sell. The people who pulled their money out to wait for things to calm down, locked in their losses, and then missed the recovery entirely. Meanwhile, the boring, consistent, automated investors just kept going and came out on the other side with more shares and higher returns. Market downturns for a long-term investor aren't disasters. They're sales, and you should treat them exactly like that. Which brings us to the single most important practical habit that separates the investors who actually stick with this for a decade from the ones who quit after a few months. Automation. The investors who win long-term don't rely on willpower. They don't sit there every single month making a conscious decision about whether to invest or not. They don't check if the market feels right. They don't wait until they're in the mood. They set up one automatic monthly transfer that pulls $100 from their bank account and drops it directly into their investment account on the same day every single month, and then they never think about it again. And here's why that matters so much more than it might sound. Willpower is finite. Motivation comes and goes. There will be months when your car breaks down, when you have an unexpected expense, when the market is red and the news is scary, and everything in your gut is telling you to pause. And if investing requires a conscious monthly decision, you will eventually miss a month. Then two. Then you'll tell yourself you'll catch up later, and later never comes. But if it's automated, it just happens. The money moves before you even have a chance to talk yourself out of it. Emotion never enters the equation. Consistency becomes effortless because you remove the decision entirely. That one setup, taking maybe 15 minutes to configure, could easily be worth tens of thousands of dollars to your future self. Now let me talk to the people watching this, who are thinking it's too late, who feel like they should have started years ago, and now the ship has sailed. I want to be direct with you about this. Yes, time is the most valuable ingredient in compounding, and starting earlier will always beat starting later, all else being equal. But here's what's also completely true. The second best time to start is right now. Not next month when your finances feel more settled. Not after you've done more research. Not when you get your next raise. Right now, today, with whatever you have. Because the version of you 10 years from now is going to look back at this exact moment. And that future version of you will either be grateful that you started or frustrated that you waited again. And the gap between those two choices, between starting today versus waiting just 2 years, isn't just the $2,400 you would have contributed in those 2 years. It's everything that $400 would have compounded into over the following 2 decades. That gap could easily represent $30,000, $40,000, or more by the time you reach retirement. Waiting feels neutral. It doesn't feel like a decision. But financially, it is one of the most expensive decisions you can make. Here's what I would actually do if I were starting from zero right now. The moment this video ends, I wouldn't sit there thinking about it or replaying everything I just heard. I'd act. I'd open a brokerage account today. Not tomorrow, not when I have more money, not when I feel more ready. Today, because the biggest lie people tell themselves is that they need the perfect moment to start, and that moment never shows up. Then I'd keep it as simple as possible and pick an S&P 500 ETF with a low expense ratio. No trying to be smart, no chasing trends, no convincing myself I can beat the market. Just something steady that's been quietly working for decades. After that, I'd set up $100 a month, automatic, on my payday, so I don't have to rely on motivation or discipline every single time. The decision gets made once, and then it runs without me getting in the way. And then I'd do something that feels almost wrong at first. I'd close the app and leave it alone. I wouldn't check it every day, I wouldn't react when it drops, and I wouldn't get carried away when it goes up. Because that's where people destroy their results. They turn a long-term system into a short-term emotional game. One bad week, and they panic. One good week, and they think they've figured everything out. I'd refuse to play that game. I'd let it be boring. I'd let it be slow. I'd let months go by where it feels like nothing is happening. Because that's exactly what it's supposed to feel like in the beginning. And over time, something subtle starts to happen. Not overnight, not even in a year, but gradually. You start to see that the habit matters more than the amount. You realize that showing up every month, no matter what, is the real win. 10 years from now, when I open that app, the number I see isn't just money, it's proof. Proof that I didn't quit when it felt pointless. Proof that I stayed consistent when it wasn't exciting. Proof that I trusted a simple process, while everyone else was jumping from one opportunity to the next. And the crazy part is, by then, increasing that $100 to $200 or $300, or even $500 a month doesn't feel like some huge sacrifice. It feels obvious. Because I've already seen it work. I've already built the identity of someone who follows through. And when you stretch that timeline out even further, another 10, 20 years. The numbers stop being small. They become meaningful. They become options. They become freedom in a very real, tangible way. And all of it traces back to something almost laughably simple. Deciding to start with $100 a month and not stopping. That's it. No genius strategy, no perfect timing, no secret edge. Just doing something ordinary for an unreasonably long time. That's what people who are financially free actually did, whether they talk about it or not. And the uncomfortable truth is, there's nothing stopping you from doing the exact same thing except the decision to begin.